This is Dr. K. Jagannayaki, Professor in MBA Department, Institute of Aeronautical Engineering, Hyderabad. So in previous session, I discussed about what is ratio analysis, what is the need for ratio analysis, why companies they will apply different kinds of ratios to analyze their financial status. So today I want to discuss with you about the applications of ratios, various ratios in real life situations by taking some kind of examples on ratio. After going through this topic, the learner will be able to understand the application of various ratios in real life scenario. So let us take few examples. The following is the balance sheet of a company as on 31st March. So a balance sheet consists of two things: on left hand side liabilities, right hand side assets. So using this data, so like share capital, we have given 2 lakhs, profit and loss account 30,000, general reserve 40,000, and 12% debentures 4 lakh 20,000, sundry creditors 1 lakh, bills payable 50,000. On the other side, assets, land and buildings 1 lakh 40,000, plant and machinery 3 lakh 50,000, stock 2 lakhs, sundry debtors 1 lakh, bills receivable 10,000, cash at bank 40,000. So calculate current ratio, quick ratio, inventory to working capital, debt to equity ratio, proprietary ratio, capital gearing ratio, current assets to fixed assets. So first starts with current assets. So current assets equal to current ratio is equal to current assets divided by current liabilities. So as I told you, current assets which can be easily convertible into liquid form. So like stock, sundry debtors, bills receivables, cash at bank. So these are known as current assets which derived from the given problem, and current liabilities identified as sundry creditors and bills payable. So using this, first we have to find out the current ratio. So current assets is equal to stock. So stock is 2 lakhs plus sundry debtors 1 lakh, so 3 lakhs, plus bills payable, that is also current asset 10,000, and cash at bank. These four are current assets. So this is 3 lakh 50,000. And current liabilities, sundry creditors and bills payable. So sundry creditors 1 lakh plus bills payable 50,000. So 1 lakh 50,000 current liabilities. Then substitute these values in the formula current assets by current liabilities, 3 lakh 50,000 divided by 1 lakh 50,000. So the ratio of current assets and current liabilities is 2.33 is to 1. So what does it mean? What is 2.33 and what is 1? The ideal current ratio should be 2 is to 1. It means that current assets should be double than current liabilities. If your ratio indicates 2.33, means the company is financially very good, with sound financial status. And second one, quick ratio. The formula is quick ratio is equal to liquid assets by liquid liabilities. So if you state that stock cannot be easily convertible into cash, it takes some time. So apart from this stock, if you take sundry debtors, bills payable, receivables, cash at bank, these three are known as liquid assets. And liquid liabilities includes like accounts payable, short-term loans, and current portion of long-term debt. So in this case, we have two liabilities, both are liquid, given in the problem. Liquid liabilities like sundry creditors, bills payable. So using this quick ratio by inserting in the formula 1,50,000 divided by 1,50,000. So our quick ratio is 1 is to 1. This also sounds good. And inventory to working capital, it can be derived by the formula inventory divided by working capital. So working capital is nothing but it is the difference between current assets minus current liabilities. We know current assets total is 3,50,000 minus current liability 1,50,000. So the difference between these two is our working capital. So inventory given in the problem, that is also 2 lakhs. So 2 lakhs divided by 2 lakhs, our inventory to working capital is 1 is to 1 ratio. Next, debt to equity ratio, which can be derived by the formula long term debt to debt divided by shareholders fund. So how can we get shareholders fund? Shareholders fund is nothing but it is the difference between total assets minus total liabilities. So total assets means current and fixed assets. Current and fixed assets. So if you go through this, the current assets and fixed assets, plant and machinery, land and building, these two are known as fixed assets, stock, sundry debtors, bills receivables, cash at bank are denoted as current assets. So using that data, total assets minus total liabilities. So assets we know, but coming to the liabilities, 12% debenture, that is also liability, plus bills payable plus sundry creditors. So total assets by total liability 4,20,000 divided by 2,70,000. So debt to equity ratio is 1.56 is to 1. The next proprietary ratio, the formula is shareholders fund divided by total assets. So already we have given shareholders fund, that is 2,70,000 divided by total assets 8,40,000. 8,40,000. Then we used to have proprietary ratio 0.32 is to 1. Next, capital gearing ratio, which can be derived by the formula capital gearing ratio is equal to fixed interest bearing securities divided by equity share capital. So the data already furnished in the problem, directly we should take the data 4,20,000 divided by equity share capital is 2 lakh. So based on that, we have calculated capital gearing ratio, which is equal to 2.1 is to 1. The next, current assets to fixed assets ratio, that can be derived by the formula current assets divided by fixed assets, which is equal to 3,50,000 divided by 4,90,000. So current assets to fixed assets ratio is equal to 0.714 is to 1. Let us take another example from the following particulars found in the trading profit and loss account of a company limited. Work out operation ratio of the business concern. So we have given trading account and also profit and loss account of a company. So now using this data, we have to calculate operation ratio. Operating ratio is equal to cost of goods sold and other operating expenses divided by net sales into 100. So first we have to calculate cost of goods sold. So what items comes under that? Opening stock plus purchases plus direct expenses. If you add these three, the total is 8,100. From that, we have to subtract closing stock. Closing stock is 600. Then we'll get cost of goods sold 7,500. Then coming to the other operating expenses, we have given administrative expenses amount 1,600, selling and distribution expenses 300, financial expenses 100. So if you add these three, will get operating expenses. The amount is 2000. Now substitute in the formula. Operating ratio is equal to cost of goods sold and other operating expenses divided by net sales into 100. So cost of goods sold 7500 plus other operating expenses 2000 divided by net sales 10,000 into 100. Then our operating ratio is 0.95 or 95%, which shows the efficiency of the business. The next, another example, on the basis of information given in the following table, calculate gross profit ratio, debt equity ratio, working capital turnover ratio. So we have given net sales, cost of goods sold, current assets, current liabilities, paid up share capital, debentures and loans. So the first one is gross profit ratio. So gross profit can be computed by using the formula gross profit is equal to net sales minus cost of goods sold. So net sale 30 lakhs minus cost of goods sold 20 lakhs. So our gross profit is 10 lakhs. Then gross profit ratio calculated by the formula gross profit divided by net sales into 100. So gross profit 10 lakhs divided by net sales 30 lakhs into 100. So the gross profit ratio is 33.33%. The next, we have to compute debt equity ratio. So total debt can be find out by taking into consideration short term plus long term liabilities. So under short term means current liabilities plus debentures plus loans. So current liabilities 2 lakhs plus debentures 2 lakh 50,000 and loans 1 lakh 25,000. So our total debt becomes 5 lakh 75,000 rupees. Then using that information, compute debt equity ratio. So debt equity ratio is equal to total debt divided by total equity. Total debt is 5 lakh 75,000 divided by total equity 5 lakhs. So our debt equity ratio is 1.15 is to 1. And next one, working capital turnover ratio. Average working capital is equal to current assets minus current liability divided by 2. So current assets given in the problem 6 lakhs minus 4 lakhs divided by 2. So 2 lakhs divided by 2. Therefore our average working capital is 1 lakh. Then using this data, compute working capital turnover ratio. The formula is net sales divided by average working capital. So net sales given in the problem, that is 30 lakhs divided by average working capital 1 lakh. Then we can able to find out working capital turnover ratio as 30. Then take another example. A company with a current ratio of 2.5 is to 1 and quick ratio of 1 is to 1 has current liabilities of 26 lakhs indicate how the following would affect the current ratio and quick ratio, and also state the amount by which net working capital is affected. Treat each item separately. First one, purchase of raw materials on account, that is 2 lakhs, collection of 10 lakhs from customers, payment of bills by check 3 lakhs from the current account balance. What are your observations about impact of changes in current ratio or quick ratio on net working capital? So if we analyze based on the given data, so as we know, current ratio is equal to current assets by current liabilities. So the standard limit is 2.5 is to 1 and quick ratio, quick assets by current liabilities and standard limit is 1 is to 1. If you take the first one, purchase of raw materials, what will be the impact of current assets and quick asset? So purchase of raw material is current liability. So increase of current liability decrease the ratio standard. Either you take current and quick ratios. And second, collection of 10 lakhs from debtors. So debtors are also current liabilities, but realizing cash from debtors indicates increase in cash received. So the standard of current assets can increase, but in quick ratio, debtors are not considered, so there will not be any effect on quick ratio. And third one, payment of bills by check. Cash outflows considered as current liabilities and more cash outflows through bills decrease the ratio limit. So no effect on quick ratio. And working capital, sufficient current liabilities are also required to protect the ratio limit in the form. Otherwise, adverse effect will come. Then another classification of ratios, balance sheet ratios. So we have the following ratios comes under balance sheet ratios because they used to depict in the balance sheet. So current ratio is equal to current assets by current liabilities, and liquid ratio can be calculated. It is also known as quick ratio, quick or liquid assets divided by quick or liquid liabilities. So liquid assets are those which are ready to convert into cash and will include cash, bank balances, bills receivable, sundry debtors, short-term investments. So inventories and prepaid expenses are not included in liquid assets. Then whereas liquid liabilities includes all items of current liabilities except bank overdraft. And third ratio is proprietary ratio, which can be derived by the formula proprietor's fund divided by total assets. So proprietor fund can be calculated by using the items share capital or equity or preference capital plus retained earning less loss if any minus fictitious assets. Then total assets equal to fixed assets plus current assets minus fictitious assets. And fourth one, stock working capital ratio, which is equal to closing stock divided by working capital. So as we know, working capital is the difference between current assets and current liabilities. Next ratio is capital gearing ratio, which is equal to fixed interest and dividend bearing funds divided by equity shareholders fund. So equity shareholders fund is equal to equity share capital plus retained earning less loss if any minus fictitious assets. Then by using this balance sheet, we need to calculate current assets liquid ratio, proprietary ratio, stock working capital ratio, capital gearing ratio, debt equity ratio. So equity share capital and preference share, general reserve, secure loans, sundry creditors, these are all comes under liabilities. Whereas coming to the assets, we have both fixed and current assets, land and building, machinery, furniture, inventory, sundry debtors, cash or bank balance. So first, current ratio. So current ratio is equal to current assets by current liabilities. So current assets is equal to inventory, debtors, sundry debtors given in the problem, cash balance. So if we add up these three, then our current assets 6,50,000, whereas current liabilities sundry creditors alone given in the problem. So that is 1 lakh. So substitute in the formula and the current ratio identified as 6.5 is to 1. So in general, the standard or ideal current ratio is 2 is to 1. It is more than that. So it means that the company is financially very strong and healthy. And second, liquid ratio. It can be derived by the formula liquid assets divided by liquid liabilities. So liquid assets means which easily convertible into liquid form means in the form of cash. So here we have sundry debtors plus cash balance. Sundry debtors is 3 lakhs plus cash balance is 50,000. So total liquid assets 3 lakh 50,000. Next, liquid liabilities. Sundry creditors alone given. So we should consider it as liquid liabilities, which is equal to 1 lakh. So substitute in the given formula and we derived liquid ratio as 3.5 is to 1. The third one, proprietary ratio. So here the formula is proprietor's fund divided by total assets. So we should know what is proprietor's fund, which includes share capital, whether it is equity or preference, plus retained earnings. If any loss is there, that should be subtracted from the retained earnings. If not, directly we can take minus fictitious assets. So in this case, we have given share capital, that is 5 lakhs, plus retained earnings 2 lakhs, and fictitious assets also given, that is 1 lakh. So total proprietary fund is 8 lakhs. Then total assets, it can be derived by the formula fixed assets plus current assets minus fictitious assets. So altogether it is 12 lakhs. Now substitute in this formula proprietor's fund divided by total assets. Then our proprietary ratio is 0.66 is to 1. Then stock working capital ratio, it can be derived by taking into consideration closing stock and working capital. So closing stock is 3 lakhs, whereas working capital, that is the difference between current assets and current liabilities, which worth 5 lakh 50,000, and our stock working capital ratio becomes 0.55 is to 1. Next, capital gearing ratio. It can be computed by the formula fixed interest and dividend bearing funds divided by equity shareholders fund. So fixed interest and dividend bearing funds means we should consider preference shares plus secured loan. So preference share value is 2 lakhs, whereas secured loan, that is 3 lakhs. Then our total fixed interest and dividend bearing funds becomes 5 lakhs, and in the same way we have to find out equity share funds. So where we used to consider equity shares plus gearing ratio. So that is general reserve. So 5 lakhs plus general reserve is 1 lakh. So total amount is 6 lakhs. And substitute in the formula and we can find out easily capital gearing ratio, that is 0.83 is to 1. And next one, debt to equity ratio. So here debt means we should consider long term debt divided by proprietor's fund. So long term debt given only in the form of secured loan, which is equal to 3 lakhs. And proprietor's fund already we have calculated, so that is 8 lakhs. So 3 lakhs divided by 8 lakhs, our debt equity ratio is 0.38 is to 1. The second category is income statement ratios, where we used to find out different types of income ratios like gross profit ratio, operating ratio, expense ratio, net operating profit ratio, net profit ratio, like that. So first one is gross profit ratio. The formula is gross profit divided by net sales into 100. The purpose of this is it indicates the efficiency of the production and trading operations. Whereas second one, operating ratio, which can be calculated by the formula cost of goods sold plus operating expenses divided by net sales into 100. The purpose is it is an index of managerial ability to control operating expenses. And third one is expenses ratio, which is equal to operating expenses divided by net sales into 100. So as expenditure may be cost of production or cost of sales, administrative or selling or distribution expenses, or any other element of growth. So this indicates the direction in which economies ought to be affected, whether they may have favorable effect or adverse effect, that can be derived with the help of expenses ratio. The next, net operating profit ratio, which can be calculated by the formula operating profit divided by net sales into 100. So the purpose of using this ratio is it is an index of operating efficiency. And next one is net profit ratio, which is equal to net profit after tax divided by net sales into 100. So with the help of this ratio, we can find out what is the net margin on sales. Then by taking one example, just we'll find out how really this ratios work out. So following is the income statement of Burj Auto Limited for the year ended 31st December 2019. So you are required to calculate gross profit ratio, operating ratio, net operating profit ratio, and net profit ratio. So this data furnished in the problem sales less cost of goods sold, then we can get gross profit. From that, if you subtract operating expenses, we used to get operating profit. For that, add non-operating incomes, if any, then subtract non-operating expenses, then we used to get profit before tax, and from that, subtract tax at the rate of 30%. Then we'll get net profit after tax. Now, only we need to replace available figures with respect to formula. Everything is same. Just we have to insert in the formulas already we have discussed. Gross profit ratio is equal to gross profit divided by net sales into 100. So we used to get 40%. In case of operating ratio, we need to consider operating profit plus other income whatever given divided by net sales. Then we got 84% like that. In each and every formula we have to insert the available data, and we can able to calculate net operating profit, and which can be identified as 16%, and net profit ratio is 12.3%. So like that, every stakeholder they used to analyze the financial status of any company based on their requirement. Either one may use profitability ratio if they want to know the profitability position of the company. If the people they want to know about the solvency or liquidity position, even if they want to assess the turnover position, everything is possible with the help of ratio analysis. Thank you.
Like, share and subscribe. Hit the bell icon for more updates.